Your savings account is not protecting you. It is costing you. And the man who manages $124 billion and predicted the 2008 collapse just confirmed, in writing, 2 days ago, that the window where that cost becomes catastrophic opens this week. 18 months. That is what Ray Dalio just put on the clock. Most people watching this will do nothing. By the time they feel it, the window will be closed. If this is the first time you're hearing Dalio's name connected to a specific timeline, drop a comment below. Say first, because what we're about to walk through is information that institutional investors are already acting on, while most retail investors haven't even seen the headline yet. Here is the arithmetic that makes everything else make sense. The federal government spends approximately $7 trillion per year. It collects approximately $5 trillion. That is a $2 trillion gap that does not close on its own. To fill it, the Treasury issues debt, bonds that promise future dollars to whoever is willing to buy them today. For decades, three groups reliably showed up to buy: American households and pension funds, domestic banks and corporations, and foreign central banks, China, Japan, and Europe leading the way. That third leg, the largest and most structural of the three, is now walking away in real time. China has been a net seller of U.S. Treasuries for multiple consecutive quarters. Japan has reduced its holdings. European central banks are actively diversifying away from dollar reserves. Supply is rising, demand is falling. And in any asset market, when that happens, only one thing follows: prices fall. For Treasury bonds, falling prices mean rising yields. Rising yields mean higher borrowing costs across everything: mortgages, corporate loans, auto financing, and crucially, the federal interest payments themselves. Those payments already exceed $1 trillion annually, more than the United States defense budget. For the first time in American history, in a country carrying $90 trillion in total debt, even a 1% move in average yields adds nearly $1 trillion in annual interest costs over time. The math does not stop compounding. It accelerates against itself. Open your phone right now. Open your banking or brokerage app. Whatever yield you see on your cash, your savings account, your money market, write that number down. Because in the next 18 months, that number is either going to be the floor of what you gain or the ceiling of what you missed. We are going to come back to exactly why that matters. Now connect the fiscal arithmetic to the second event, and this is where the situation stops being theoretical. 2 weeks from today, Jerome Powell steps down as chair of the Federal Reserve. His likely successor is Kevin Warsh, a former Fed governor with a hawkish inflation record. On paper, that sounds stabilizing. Here is the political reality that changes everything. The Trump administration has stated openly and repeatedly that it wants the next Fed chair to cut rates, in the president's exact words, by a lot. Ray Dalio addressed this directly on April 27th in a live CNBC interview. His exact words: "You would not cut rates now. You will lose your credibility. The Federal Reserve would lose its credibility, particularly now." 2 weeks from today, that decision-maker changes. 2 weeks from today, the institution that exists to defend the purchasing power of your dollars will be led by someone walking into a room where the President of the United States is demanding aggressive rate cuts while inflation remains sticky. The entire United States financial system operates on one foundational belief: that the Federal Reserve acts on economic data, not political pressure. The moment that belief cracks, two things happen simultaneously. The dollar weakens. Foreign demand for long-duration U.S. Treasuries collapses, and the $2 trillion annual gap that already has no reliable buyer suddenly has even fewer takers at prices the U.S. government can afford. The cycle does not just continue, it accelerates. If you've been following this channel, you know we cover exactly these kinds of inflection points before they become mainstream headlines. Like this video, share it with one person in your life who holds a standard 60-40 portfolio and thinks bonds are the safe side. They need to understand what's converging right now before the price action confirms the thesis, and the window is already gone. This is the pattern Dalio has documented across 500 years of monetary history in his research on what he calls the big debt cycle. When governments lose monetary credibility, when the central bank blinks under political pressure, the consequences play out over 12 to 36 months in a sequence that is almost mathematically predictable. Currency depreciation, inflation acceleration, capital flight into hard assets, real interest rates falling even as nominal rates rise. And on April 28th, in a Fortune interview, Dalio used a specific phrase that almost no one in financial media has repeated loudly enough. He said, and these were his exact words, "We are certainly in a stagflationary period. Not approaching one, not risking one, already in one." Stagflation is the policy nightmare that makes the Federal Reserve's standard toolkit self-defeating. Cut rates to support growth, you accelerate inflation. Hold rates to fight inflation, you risk recession. The new Fed chair walks into this trap in 2 weeks with maximum political pressure pushing him in exactly the wrong direction. But here is the third converging force, and this is the one almost nobody is discussing publicly. This is the one that ties the fiscal pressure and the monetary pressure into something that cannot be resolved by normal institutional mechanisms. In his May 3rd statement, Dalio explicitly forecast that Republicans will lose the House of Representatives in the November 2026 midterm elections. He went further. His exact wording predicted what he called great conflicts, including impeachments, investigations, and so on. Translate that into financial language. Dalio is forecasting that the United States will enter the most fiscally exposed 18 months in modern history, with 3 simultaneous failures operating in the same direction at the same time. A Congress that is politically paralyzed, a Federal Reserve under direct political pressure to inflate away the debt, and a foreign creditor base that is already pulling back from U.S. assets at a structural level. These are not 3 separate risks running in parallel. They are 3 mechanisms feeding the same outcome. The fiscal gap cannot close without political consensus. Political consensus cannot form during impeachment proceedings. Without political consensus, the entire pressure migrates onto the Federal Reserve. And if the Fed is being directed politically to accommodate rather than defend, then the only remaining release valve is currency debasement, the dollar weakening against everything that cannot be printed. Now here is the parallel that is not loose. It is not an approximation. It is mathematically precise. 1978. The federal government was running fiscal deficits to finance post-Vietnam commitments and expanded social programs. Inflation had risen above 9%. The Federal Reserve was in a leadership transition. President Carter appointed G. William Miller as chair. Miller faced enormous political pressure to keep rates accommodative. He blinked. He chose accommodation over credibility. What followed was not gradual. Gold moved from $180s per ounce to over $850 in 18 months, a 400% move. The S&P 500 lost roughly 40% of its real purchasing power measured against gold over the same period. Long-duration Treasury bondholders lost more than half their real wealth. The savers who did nothing, who trusted that their bank account was the safe choice, watched their purchasing power cut in half. Not because they made a bad investment, because they trusted the dollar at the exact moment the dollar was being politically pressured to lose value. Carter was eventually forced to replace Miller with Paul Volcker, who took rates to 20% to break the inflation that accommodation had allowed to entrench. The cure was more painful than the disease would have been. The same configuration appeared in 1971 when Nixon ended the dollar's gold convertibility under fiscal pressure from Vietnam. Gold moved from $35 to $200 within 30 months. The same configuration appeared in 2008 when monetary stimulus was deployed against structural debt. Gold moved from $700 to $1,900 over 36 months. The same configuration is converging right now. Powell leaves in 2 weeks. The fiscal gap is $2 trillion annually with no structural solution. Political conflict is mathematically forecast by Dalio himself. We are in week 1. Bridgewater's documented research, portions of which have been made public, shows that across monetary transitions in the post-war era, where these 3 conditions converged simultaneously, the data is consistent. Gold averaged real annual returns above 25% during the 18-month window following convergence. Energy companies with structural pricing power averaged real returns above 20%. Long-duration nominal bonds averaged real losses exceeding 15% annually. Cash held in checking and savings accounts lost 5 to 12% annually in real purchasing power terms. This is not a theory. It is a documented pattern repeated across 3 major historical episodes with remarkable consistency, and it points directly to 4 specific asset categories worth understanding right now. The first is gold and physical precious metals. The most accessible instrument is GLD, the SPDR Gold Trust, available through any standard brokerage account. For larger allocations, IAU from iShares carries lower expense ratios. For direct exposure outside the financial system, allocated physical storage through services like the Perth Mint or Bullion Vault removes counterparty risk entirely. Central banks themselves have been the largest net buyers of gold for the past 12 months. Over 1,000 metric tons purchased in a single year, the highest sustained pace in 50 years. They are not buying because the price is rising. They are buying because they understand what is converging before the price action reflects it. Sovereign wealth funds are doing the same thing. The institutional capital is moving now. The retail price action follows later. The second category is energy companies with structural pricing power. The most accessible instrument is XLE, the Energy Select Sector SPDR Fund, providing diversified exposure to the largest integrated U.S. energy producers. For more concentrated exploration and production exposure, consider XOP. For dividend-focused energy positioning, AMLP provides MLP exposure with income characteristics. When monetary policy is pushed toward accommodation while supply chains face geopolitical disruption, energy becomes the most reliable inflation pass-through asset in the entire equity market. Energy producers are not hurt by rising energy prices. They are the rising energy prices. In the 1973 OPEC shock period, when the S&P 500 lost 48% peak to trough, integrated energy companies posted some of the strongest returns of any sector in the market. The pattern repeated in 2022. Energy gained over 60% in a year, while technology fell 30%. The divergence in those two environments was not random. It was structural. The third category is short-duration fixed income and Treasury inflation-protected securities. SCHP from Schwab provides low-cost TIPS exposure. VTIP from Vanguard holds TIPS maturing in 5 years or less for shorter duration sensitivity. BIL from SPDR holds 1 to 3 month Treasury bills for pure short-duration positioning. This is where a critical mistake gets made. Long-duration bonds and short-duration instruments are not the same asset class in this environment. They perform in opposite directions. In 2022, long-duration bond funds lost 20 to 30% of their value. Investors thought they were in the safe part of their portfolio. They were in the most exposed part. Short-duration instruments mature quickly and roll over at higher rates as yields rise. TIPS adjust their principal automatically as inflation rises. In a stagflationary environment with monetary credibility loss, the distinction between these two is not a nuance. It is the difference between preserving purchasing power and losing it silently. The fourth category is international diversification away from concentrated U.S. dollar exposure. VIXUS from Vanguard provides total international equity exposure across developed and emerging markets. VWO and EEM give pure emerging market exposure. EWJ, VGK, and FXI provide region-specific access to Japan, Europe, and large-cap Chinese equities, respectively. Dalio stated this explicitly. Capital is rebalancing away from U.S. assets at a structural level. In 2025, the MSCI Emerging Markets Index returned 33%, double the S&P 500's 16%. European, UK, Japanese, and select Chinese equities all outperformed U.S. equities in dollar terms. Dalio's exact words on this rebalancing: there were big shifts in flows, values, and in turn wealth away from the U.S., and what is happening will probably lead to more rebalancing and diversifying. This is not a temporary anomaly driven by a single quarter. This is the early measurable signal of structural capital rebalancing as global money responds to the exact conditions we have spent this entire video documenting. Open your brokerage account right now. Not after the video, right now in a second tab. Look at your asset allocation. What percentage is sitting in U.S. equities concentrated in technology and growth? What percentage is in gold or precious metals? What percentage is in energy? What percentage is in short-duration fixed income or TIPS? What percentage is in international or emerging market equities? Most people watching this will find they are nearly entirely concentrated in exactly the categories that have historically underperformed during this specific type of monetary transition. That is not safety through diversification. That is concentrated exposure to the wrong side of a documented historical pattern. Here is the framework Dalio's research points toward for the 18-month window we just entered. These are structural positioning ratios, not stock picks, not predictions, not guarantees. They are the allocation logic that has historically provided real purchasing power protection during this specific type of transition. Approximately 15% in gold exposure through GLD or IAU, approximately 25% in energy sector exposure through XLE, approximately 15 to 20% in TIPS or short-duration treasuries through SCHP, VTIP, or BIL, approximately 15% in international diversification through VXUS, the remainder in your existing diversified U.S. base. At any portfolio size, these percentages scale identically. What changes with larger capital is the granularity of execution. Individual energy names alongside the ETF, a small physical gold allocation in allocated storage, region-specific international ETFs for more precise exposure, and a quarterly rebalancing discipline that forces you to sell strength and buy weakness systematically rather than emotionally. The specific instruments matter less than the framework. The framework is what provides structural protection across an 18-month window where the dollar is under political pressure, the Federal Reserve is under institutional pressure, and the political environment itself is forecast to enter constitutional conflict. Bring this together. 2 weeks from today, Powell leaves. Warsh steps in under maximum political pressure to cut rates aggressively into a stagflationary environment that Dalio has already declared we are in. The federal government continues spending $7 trillion annually against $5 trillion in revenue. Foreign demand for the resulting $2 trillion in annual debt issuance is structurally weakening. The midterm elections will likely produce political conditions that Dalio explicitly forecasts will trigger impeachment proceedings, removing Congress as a functional institution for fiscal management. 3 mechanisms, fiscal, monetary, political, are not 3 separate problems. They are one problem with 3 accelerants, and we are in week 1. The window between when conditions become visible to informed observers and when price action confirms the thesis to everyone else is historically 6 to 12 months. In 1978, gold had already moved from $180 to over $400 before most savers understood what was happening. By the time inflation was impossible to ignore, the window had compressed. The people who held cash did not make a bad investment. They made no investment. And the difference between those 2 choices, measured in real purchasing power over the following 4 years, was catastrophic. You are not those savers. You have the framework. You have the instruments, GLD, XLE, SCHP, VXUS, available in any standard brokerage account in under 15 minutes of execution. You have the real-time signal of Ray Dalio publicly stating 2 days ago that this specific 18-month window has opened. The information gap between institutional investors and retail investors does not last forever. It lasts until the price action closes it. Right now, that gap is still open. There are 2 kinds of people who watch a video like this. The first kind will open their brokerage account in the next 24 hours, look honestly at what they're holding, and make at least one concrete move toward this framework. The second kind will close the tab feeling informed, and do exactly what they were already doing. Both people have access to the same data. Dalio's numbers are public. The fiscal gap is public. The Fed transition is public. The historical pattern is documented. The only variable is whether you act on information or collect it. Drop your current allocation percentages in the comments right now. Just the numbers, no explanation needed. Not to impress anyone. Because behavioral research is consistent on this point. Publicly stating a financial position measurably increases the probability of acting on it. Write the number, then go open the account. If this changed how you see the next 18 months, consider subscribing for daily updates. The next video breaks down the specific energy names within XLE that Dalio's pricing power framework points to, with the exact selection logic and rebalancing timing for this window. The data is public. The window is open. Week 1 does not last.